The United States government now pays more money to its creditors than to its soldiers. That sentence would have been impossible 5 years ago. Today, it's federal budget reality. Look at the Times Square debt counter. It's racing past $36 trillion in U.S. national debt. For decades, American economic experts reassured us. They called it a video game high score. Frightening to look at, but harmless. Then 2024 arrived, and the United States debt stopped being theoretical. It became a living thing feeding on the federal budget. History just turned a corner. Washington now spends more servicing old debt than protecting the nation. Fiscal year 2024. Interest payments, $892 billion defense budget, $874 billion. Let that sink in. For the first time in American history, yesterday's creditors now get paid more than today's soldiers. And this is just the opening act. By 2030, U.S. interest payments will hit $1.4 trillion, dwarfing Social Security and Medicare. Welcome to America's debt spiral. Inside it lives a silent decision. We are going to quietly reduce this burden, not through repayment, but through inflation. If you want to understand exactly how this affects your money and what you can do about it, hit that subscribe button right now, because what I'm about to show you isn't being discussed anywhere in mainstream media. Federal spending isn't a menu where you pick and choose. 70% of the U.S. budget is mandatory. Social Security, Medicare, debt interest. These are sacred promises to American citizens. Cutting them is political suicide. So Washington borrows fresh money just to pay interest on the old money. A mathematical snake eating its own tail. 2 decades ago, America's debt was 55% of GDP. Now it's 123%. We are beyond World War II peaks. But without the post-war economic boom, we're navigating permanent stagnation. A debt this massive leaves only 3 escape routes for the United States. Door 1, austerity. Double income taxes or eliminate the military overnight. Politically impossible in America. Door 2, default. Tell the world we aren't paying. This triggers a full-blown debt crisis. The global financial system is built on one assumption. U.S. Treasuries never fail. Break that assumption, and global credit markets collapse overnight. That leaves door 3, the quiet exit. Pay every penny owed, but in dollars that are losing value every year. This isn't conspiracy theory. It's Washington's documented operational strategy for managing America's debt crisis. Now, some economists argue the U.S. can simply grow its way out of this problem. Here's why that math no longer works. U.S. GDP grows around 2 to 3% annually. The debt is growing at 5 or 8% annually. We're not outrunning this. We're falling further behind every single year. The mechanics are straightforward. Keep borrowing costs below the inflation rate. If inflation runs at 5% and interest rates stay at 3%, the real value of the U.S. national debt shrinks by 2% annually. The American government eliminates trillions in obligations without passing a single law. This creates what economists call fiscal dominance. In 1981, Federal Reserve Chairman Paul Volcker raised rates to 20% to kill inflation. Today, that's no longer an option. If rates hit 10% now, U.S. interest payments would exceed total federal tax revenue. The American government would cease to function. So, the Fed has no choice. They must accept elevated inflation to keep the U.S. Treasury solvent. Central bank independence becomes extremely difficult to maintain under these conditions. But who buys bonds that guarantee losing money to inflation? The free market would demand 10% returns. America can't afford that. The solution? Change the rules. Regulations like Basel III and Dodd-Frank require U.S. banks and pension funds to hold treasuries as premium liquid assets. Your American retirement fund isn't buying government debt because it's a sound investment. It's buying government debt to comply with federal regulations. The U.S. financial system is structured to provide Washington with low-cost funding, regardless of market conditions. To make this strategy work, methodology changes. Since the 1980s have significantly altered how inflation is measured. Social Security payments and TIPS bonds are adjusted based on the Consumer Price Index. If official inflation runs high, the U.S. government pays more to retirees. So over decades, the calculation methods evolved. Substitution bias. When steak prices jump, the formula assumes you switch to hamburger. Your actual cost of living rises, but the official data shows a smaller increase. Hedonic adjustments. A new car costs $5,000 more. The formula attributes this to quality improvements, so the price increase gets understated in official statistics. Independent economists, using older methodologies, consistently show inflation running several percentage points higher than official government figures. We are replaying the post-World War II playbook. In 1945, U.S. debt hit 119% of GDP. We didn't pay it off. We inflated it away. For an entire decade, the Federal Reserve capped interest rates at 2.5%, while inflation averaged 6%. American bondholders lost purchasing power every single year. By 1955, the U.S. debt-to-GDP ratio had crashed to 60%. It was a massive wealth transfer from savers to the federal government. The blueprint for the 2030s is remarkably similar. Cut the American national debt ratio in half by reducing the real value of every dollar by half. The difference? In the 1950s, America was the world's factory with no economic rivals. Today, we're attempting this with an aging population and global competition for reserve currency status. This mechanism is what drives the growing inequality crisis in the United States. New money doesn't distribute evenly across the economy. It enters through Wall Street first. This is called the Cantillon effect, named after an 18th century economist who first noticed that whoever gets new money first benefits most. U.S. banks and major corporations receive the fresh liquidity first. They immediately buy assets, stocks, real estate, technology companies, before prices adjust upward. By the time this money reaches wages and Main Street, asset prices have already skyrocketed. Since 2008, we've watched a K-shaped divergence unfold across America. Asset holders saw investment portfolios triple. Wage earners saw purchasing power steadily decline. The U.S. national debt is being managed by quietly transferring wealth away from the American middle class. America is reducing its debt burden right now. It's just slow, procedural, and buried in economic policy. That $36 trillion will never be repaid in real purchasing power terms. The winners? Americans who own scarce productive assets, real estate, quality businesses, commodities, stores of value. The losers? Americans who trust the traditional system, cash savers, bondholders, workers, depending entirely on wage growth. So here's what this actually means for your financial future. The rules just changed. Cash sitting in savings accounts and traditional bonds are melting ice cubes. They're losing real value every year you hold them. But hard assets, real estate, quality businesses, commodities, alternative stores of value, these become the new savings accounts in an inflationary environment. The government is running one of the largest wealth transfers in American history. You can either be the person this happens to or the person who positions for it. That $36 trillion isn't going anywhere. But your wealth? That's still your decision. Subscribe now. Next week, I'm breaking down exactly how wealthy Americans are quietly repositioning for this new reality, and what you can do starting today. The debt clock keeps running. The question is whether you're running with it or against it.